Kalimera Seolus, Kalos irtates OIKONOMIKA. Welcome everybody and welcome to OIKONOMIKA, all about economics. Very happy to be with you all today. It's been a long time. I hope you're all well, or alive and in good health and peaceful as much as possible. And I have here a great content for you today. I'll try to provide a clear picture around the global oil market. I don't have this great expertise, but I have spent, I think, a week or more, more than a week, studying around data. So I will show you some modeling of crude oil prices, oil futures, yield curve, the theoretical increase in inflation that we are going to see going forward because of the tension in the Middle East and the oil market disruption, supply chain disruption. So I'll try to provide a clearer picture, and so as you can see here on my screen, we can start from the assumption that the global, according to the latest data, the global oil demand, it's around 102, 104 million barrels per day, and the global oil market supply or production, it's around 106 or 107 million barrels per day. And also the chart here, it's from the EIA, so it's the American, the United States energy agency that keeps track of, has all the data around the energy market, and their assumption is that actually the global oil market is been working, or it's be able to keep a 1 million barrel per day of crude oil surplus, as we can see here. The light blue line, it's more or less, there should be a spread of a 1 million barrel per day of crude oil of surplus between supply and demand, and this in normal times, this should allow the oil price to be stable, and for oil producers or oil or commodity traders to basically build a inventory or stockpile of crude oil, and then work it through the year according to demand, supply, what is the futures price, if it's in contango or in backwardation, etc., etc., etc. But what is the problem now? The near-term issue is that we have 1 million barrel per day, more or less, of surplus between production and demand globally per day. But according to how the overall Middle East situation evolves, we can have a series of scenarios, because the same EIA, the same energy agency from the United States, but it's basically common knowledge that, for example, the Strait of Hormuz, through the Strait of Hormuz, we have around 20 million barrels per day of crude oil products. That includes also natural gas or LNG, liquefied natural gas. And so if there's any disruption to the shipping routes, or if there's even more disruption in the Iranian crude oil production, if some basically facilities are unfortunately destroyed or degraded, or anyway, there are these other two variables. So you can see easily that the 1 million, the very tiny margin of surplus supply in global oil production, which is around 1 million barrels per day, it can easily disappear. It can easily become a deficit vis-a-vis the global oil demand. If the Strait of Hormuz becomes unviable, or the volume of crude oil transiting the area diminishes a lot, and also if Iranian crude oil doesn't reach the global oil market, and we've seen in the past days very shocking images, but Iranian people, they were already there were kilometers of cars queuing for gasoline. So there are, of course, obviously there are huge disruptions, and so we should already take into account that energy prices, for sure, they are going to be at these levels, if not higher, going forward. Of course, hoping that the overall situation in the Middle East basically goes back to some sort of normality. There is some sort of peace, and so we can hope for the best. But if we basically take stock or consider what are the global oil supply and demand balance, we know that we have a surplus of 1 million barrels, but if we have a disruption in the Hormuz Strait or in some sort of global production from Iran, then we can easily understand the supply and demand curve goes into deficit, so the demand outstrips the available supply of oil and gas. And so we can expect, for example, that we will have some, for sure, we will have some inflationary effects on the global economy. In this case, are managed with very unrefined data to find out more or less, for example, if we have a 20% oil price shock, you can all see the curve is a downsloping curve which fades with months going by, from 0 to 5 months, 10 months. So the bulk of the inflationary uplift, in this case for United States inflation or Euro area inflation, it can be as high as 1% or even more. But more reasonable inflationary effects are, or pass-through effects are in the order of 0.7% if oil price are sustained at 10% increase in the oil price for this period and also in the coming months. So if energy prices, they are sustained at a higher level, then of course we will see an increase in inflation in the coming periods. And so for sure we will have an inflationary effect in the economy that derives from oil price and derives also from gasoline price for car drivers. And here we see that we have a proportion between the oil price. So if we have a jump of $21, the effect on the overall CPI inflation measure could be as much as 3%. So there will be effectively another energy shock, another inflationary energy shock to the economy, and that will be the usual difficulties that we are we are used to live through. And I think we are very, very lucky at the minute just to have to deal with inflation. And as I was already saying, is that through the Strait of Hormuz we have 20 million barrels per day of crude oil product transiting through that route, and also a natural gas product. So here, for example, if we have a partial closure, like 30% of shipping volumes, more or less around 6 million barrels per day, are disrupted, then there can be a potential spike in oil price. It would be of $3. So if there is full closure of like the Strait of Hormuz is unviable, we have a 21 million barrel per day disruption, so the oil price is going to jump by $10. But these are basically arithmetic estimates. So then after considering the medium to longer term implication, if the Strait of Hormuz becomes unviable, I think the jump in the oil price would be structurally higher. And but nevertheless, this is very basically to understand that the global oil market, it's working now around a million barrel per day of surplus. and if we have a very small disruption like 5 or 6 million barrels, the volume of shipping through the Strait of Hormuz goes down by 10, 20 or 30%, then the global oil market suddenly finds itself in a deficit situation, and then the oil price is bound to be priced much higher, like $3, $5, $10, etc. And then there are all the associated. I think this. I'm sure that these scenarios have been basically talked about many times, but there, because in some previous periods we had already issues with Hormuz Strait, that area of the globe, and we have all the associated costs, because if the shipping routes are redirected through South Africa and the Cape of Good Hope, we have 14 additional days of navigations. That increases the cost of shipping. It delays, not it delays, but it lengthens the amount of time that it's required from any sorts of crude oil products, or even any goods and any shipment that comes from Asia. So the transit time it becomes longer. It takes 14 days longer to go through South Africa. We have an increase in the shipping costs, increase in insuring some cargoes because it's more dangerous. So all these factors all together, they become an inflationary cost down the pipeline, because those that work with in the shipping industry, then they will have to pass through the cost of higher shipping costs to the buyers and the suppliers and so forth and so on, down the chain of consumption to the retail price and the consumer. So there are two effects, which are less capacity in less volumes of crude oil that could eventually be disrupted through the Strait of Hormuz, and then we have, if ships are routed through South Africa, then that becomes adds additional costs. But I think this is a scenario that the global economy has faced already, so people are well aware that all these kind of situation, they bring higher costs basically in doing anything, and for sure they basically will show up like in the morning news bulletin. Oh, inflation this month or the past month was higher by 0.2 or 0.4. Oh, we have a jump in inflation, because there are if we know that there are disruption in the global oil market, then, or in the shipping market, then that for the consumer, then that becomes a higher cost. Then we can jump on the briefly on the charts of crude oil. I'm not here to suggest any speculation about these things. I'm not interested at all, but I just want to highlight a few things that can be useful for the average person. I don't know if, okay, yeah, it's working, it's okay, it's more or less, yeah. So anyway, what we can see here is that I just plugged the line here is around 55.60, 55.75 dollars per barrel, which is the lowest crude WTI, so is Western Texas Intermediate crude oil, light crude oil price. The lowest price we got like in May, before all the chaos, has been around $55 and change, $55.60 or 75. So we could theoretically assume, we can see on the chart that below the $55 mark, the market is not able to price crude oil, and that basically it's an automatic. It's a function of global supply and demand, because demand has been growing for the past 2 decades. We started in the year 2000 with 70 roughly 72 million barrels per day. In 2024 and 2025, we are going well above the 100 million barrels per day. So in 20 years, in a bit more than 20 years, the global oil demand has increased by 30 million barrel per day of oil. So all in the face of the green economy. So it's an increase of almost 50%, because if in the year 2000 we were at 70 million, and then 20 years later we are 100 million, we are more or less around a 40% increase in global oil consumption. So demand of oil products, it's very consistent, and that's why below the $55 the market is not gonna go any time in the near future. And so from here, I mean, there is not much to argue or to say. I don't want to spend a lot of time with the technical analysis, because there are other means to understand how oil price could behave. And but nevertheless, if by taking as assumption that if we have a shipping problem with the Strait of Hormuz, or a decrease in volume of crude oil that comes into the market, then we can assume that oil price can be as high as $80 or $90, $100. I mean, in the news there are speculation of all sorts, but nevertheless, let's try to if we take a similar period here, like in 2005, so 20 years ago, we were around here, this level, same levels here, and for some sort of reason then the oil price went up to nearly $150. That was speculation or some sort of market pricing of commodities. But anyway, we have seen already in 2022 that the oil price went to $130. Now in the past weeks we have seen a high volatility, but not a market reaction that has been so disruptive in one-way pricing of higher and higher crude oil price, because the supply has not been disrupted. So I think, for what we see in the charts is that the oil price is more or less at the same levels that has been in the past months. So at the minute, as things stands, we could basically come down and say, okay, maybe oil is not going to $80. I'm not sure, because if this geopolitical disruption, they keep happening going forward, then probably we will have higher energy prices, and maybe this won't be a one-day jump in the oil price, but will be a slow grinding of higher oil prices, so that the market works through the equilibrium between demand and supply. And if there are disruption in the supply of or the production of oil, and more or less today markets are normally behaved. There is not much volatility. That was the old volatility that we have seen in the past few days, or in the past week. Just we see here a big bar here, which is the buy volume, and nothing special. It just jumped to $78 for WTI. Nothing out of the ordinary, but nevertheless, we should be mindful that maybe oil price the commodity traders and the oil producers and all the industry that works around that needs oil as an input for their production, they will start to they will have to discount or to consider higher oil prices going forward. And another element, as I was saying, in the Strait of Hormuz, we have also natural gas that goes through the Strait of Hormuz. And we see that natural gas now, it's going up a little bit. It's 3.8, almost near the $4 mark. And the natural gas also is a big component of the energy basket for what concerns inflation. And that's why probably going forward we will have higher inflation headlines for the month-on-month or the quarter-on-quarter inflation measure. And here, last but not least, we have the chart here of the natural gas futures for the Dutch stock exchange, which are linked to electricity production prices. We are at the lowest levels since 2022, nothing so out of the ordinary. Nevertheless, we have here just a curve, like a small trend, like going up a little bit towards the 40 euros, but nothing really worrying or any sort of exorbitant 300 euro energy prices or stuff like that. So all in all, I mean, markets they have been very calm and very much very well behaved. I didn't expect that volatility was going to be so calm and subdued. And what do I expect? So what we can expect is higher crude oil prices going forward, which will mean a higher inflation. And we can reasonably expect a daily volatility of being around 1 or 2%. Unless there are exogenous factors, and then we will have an intraday jump in volatility of 3, 5, 7. I mean, 3, 5, 7% in the percentage change in dollar terms of the oil price, which can jump by 1, 2, 3, or $5 in a day, which would be very large jump in price. And we can take some data, or we can basically have a look at the crude oil futures curve, and we can understand how the market is pricing oil prices in the future. And we see that the futures curve is in backwardation. We have near-term oil prices which are higher than in futures contract, but nevertheless we see that up to January 2026, today we are having a bid up of at least $1 in the oil price higher. The nearest contract, nearest July 25, is $73. So we are having a plus 2% daily percentage change in the price. So we are within the range of ordinary daily volatility, which is plus or minus 2% for oil futures and oil prices. So basically, as things stands, and we have a tiny. The global oil market works basically is balanced around $1 million barrels per day of surplus in terms of global supply of oil. And whenever this balance basically turns into a deficit, then we will have the market producers and commodity traders. They will start to price much higher oil, crude oil prices, and that there will become much higher inflation. But I think that for sure we can expect higher inflation headlines going forward, either this summer with the higher gasoline prices around Europe and in the global economy, and higher energy prices for 2025 and 2026. So that's for the crude oil futures. We could have a look later at the option chain, which is a bit more difficult to basically to deal with. Just bear with me while the page loads up. Nevertheless, the first thing that we can see very easily is that the implied volatility it's 51%, which is quite high implied volatility. And we see also that the last here, which is the premium of the put option, which are far out of the money, it has been increasing quite a lot. This is a function of the fact, a derivative function of the fact. It's a derivative of the spike in the oil price. So the option market tends to the put the premium of put option, which are out of the money for a higher price than that we see here. The spot price is between 72 and $72.50, but to basically to have a downside protection of oil market, and we want a put option which is it's out of the money, either $80 or $90. We see that the premium it's $19, $20, so it's quite expensive to buy puts which are out of the money, and that's due to the volatility that is injected in the oil market. And we see here that the implied volatility is 70, 80, 90%. So the option market it's pricing a much higher implied volatility, of course, because there are all sorts of disruption in the global oil market, and also all sorts of uncertainties around geopolitics. So now I'll bring you through my own work. Of course, I cannot show you everything because it's a lot of work. It took me more than a week to work through all of this. So where to start? So we can start from here. I think it will be very useful for everyone to basically to have a look at this. So what I'm showing you now is how the machine, how Python models through the time series of data. And I want to, okay, we can see here, we have here a, if I'm not wrong, is 37 tickers, so it's 37 time series data. It's more than 4,000 days of daily data. And we have here the Brent and WTI and the gold and copper price and heating oil price, I presume. And then I added a raft of futures contract. That's what we just saw now on the bar chart website. And the series start 2005, and we have an end date which is basically it updates every day. So I can easily run through the model every day, and I update everything every day. So it's very, very useful. Yeah, 36 time series. And this is very, I mean, we're not talking about funny stuff, but this is MC nuts. Are you nuts, mate? Okay, I'm not writing it properly. I'm probably more pronouncing it. So it's a Markov chain Monte Carlo nuts, which is not U-turn. It's not a U-turn model. Nuts. It's not a U-turn. So basically, that's very useful because by doing this, you are able to have a point estimate of what is the mean average daily return of the asset class, or the financial asset that you are studying, and the point estimate of the volatility and so forth and so on. So having a point estimate, basically it provides you a range, which HDI is the high density interval. So here, for example, we see that the average daily return is very close to zero. Okay, so we have here a posterior mean distribution for Brent crude. So the posterior mean distribution is a probability distribution when we start from the assumption that the average daily return is within a range. So we have an expected a conditional probability of some data which is conditional to another parameter theta, and then we want to estimate, and then we basically are able to, or the machine is able to work through and to model what is the posterior, the aftermath of after all the calculation. We have what is the average mean and the average daily return or the average standard deviation, and it provides very nice range. And we have also another parameter which is nu. This one is very nice. And then we have a mu parameter. And the mu parameter is the average daily return. It's 0. The nu parameter is here 7.9. That's for Brent crude. So the nu parameter basically is modeled on a student t distribution, and it accounts for fat tail distributions. So paradoxically, the smaller is the parameter, the larger are the fat tails. If we have a new parameter which is larger than 10 or larger than 20 or 30, then we have very thin tails. So we don't have the distribution of the data, the observation of the data that we have. It doesn't exhibit fat tail distribution or higher volatility. That means that you have like the oil price crashing 10% or going up 10% in one day. Like we saw in 2020, the oil price went to -$40, -$10, something unseen in the history of mankind. So the new parameter gives you the what is the fatness, how fat is the distribution of the data. And we have the high density interval, which provides the range and the point estimate. Okay, so the sigma here is the volatility, and we have the high density interval, which is between 1.5 and 1.8%. And then we can I hope I can do it properly. We can no, 1 second. Come on, I need to analyze this thing. 252, is that possible? Okay, yeah, I think, yeah. Okay, if we analyze 1.5% of daily standard deviation, we have a 19.4 annualized volatility. Okay, so all the parameters, they are very useful, because then you can start in very complicated way, you can start to work around which futures are more volatile, which futures are less volatile, and you can, for example, start to short some crack spreads, some future spreads, some volatility spreads in the oil market, futures market. Very complicated stuff. You can play around the volatility curve of the option market when it's crude oil, but nevertheless, the Markov chain Monte Carlo not U-turning method, it's very important because it gives us a range estimate, a point estimate of the parameters, and with that we can model through some assumption with more certainty. For example, if the average daily return of Brent crude is 0, that means that we don't have a trend. So the asset stays around 0. So it doesn't either go up, doesn't trend up or down. But what basically we have to take into account is that we have a high density interval, which is between 1.5% and 1.8%. So we know that the daily standard deviation of the Brent crude prices, the cash prices, the spot prices in the market, historically, it's between 1.5% and 1.8% daily. So as we saw here in the market today is moving around 2%. So we are within or a bit more of what are the range that this posterior mean method allows us to gather. And the charts are very illustrative. So you have like a distribution, bell curve distribution, and you see mu, which is the average daily return minus 0.001%. That's the range, more or less, very much around 0. What changes a lot is the sigma, or the volatility, and that's more or less the area, the high density interval between 0.15 and 0.018, which again is 1.5, 1.8% daily. And yeah, we have these other parameters they are very important, because they give us what are the margin square error. And so the smaller is the error, is close to zero, then that means that the model fits very much. The data is very, very precise. The R hat one parameter tells us that the model fits very, very well, so the results are very accurate and very precise. So what is important is that the high density interval of volatility under normal condition is 1.5, 1.8%, and the new parameter, this V new parameter, it's 7.9, and it's 2.47 for the standard deviation. So that means that we have fat tail distribution, so we have high volatility days, and we all know that oil market can be highly volatile. So this the type of model, this probability distribution model, has been worked through by the machine through 36 time series, which includes future contracts, which of course they don't have a lot of data, because they are futures contracts. They start they are not the same as the spot oil price, the cash price. But nevertheless, okay, posterior mean distribution WTI futures will be what it's important for me to know is that the new parameter here, it's a bit larger, so it assumes a thinner, not much extreme volatility in the tail of the distribution. Like here, we don't have fat tail, like large but very thin distribution. That's more characteristic of futures contracts, because there is less observation, and so the new parameters could be a bit more behaved, but it depends what we are going to work through. It's crude oil March 2026. We have new parameter of 7.2, so we can expect fat tail distribution. And as I was saying, the sigma parameter, it's 1%, and the high density estimate, it's here. So we have point estimate for the futures contracts, which is to measure the volatility or the average daily returns. For all time series, the mean parameter, it's around 0. And so as I've been explaining until now, as I've been saying until now, is that what are important are these parameters, which are the point estimate and the range for the volatility, the sigma, and the new parameters. And here we are going through the nearest futures contract, which is the August 2025 or the July 2025, which is the next month crude oil future contract. And let's see, the new parameter is 6.1 for the mean, and the sigma, the standard deviation, it's 1.2%, right? Estimated by the probability distribution, the Markov chain, Monte Carlo, posterior mean probability distribution. And the high density interval for the standard deviation is between 1 and 1.3%. Okay, we can see all here. I hope you can see it clearly. I'll just make it larger a little bit. And yeah, this new parameter tells us that we have fat tail distribution. The high density, it's a bit larger, it's between 3.7 and 9.1. So according to these parameters, now jumping to not to another topic, but like commodities traders, those who work with quantitative models, they would be able, for example, to estimate, okay, the point estimate interval, it's 1 and between 1 and 1.3% for the July contract, and it's one second, it's between 1 and 1.3%, 2% for the September contract. So they, for example, they could play around what are the volatility spreads, and then they there are very complicated things that like trading in oil market requires, which is volatility spreads, or also by hedging the gamma and the delta exposure in the option market. So there are very complicated stuff, and this modeling basically it's very functional for traders, or for those firms that they want to have a very detailed and in-depth understanding of what is the volatility in the oil market, and how volatile can be futures contracts, what is the daily volatility that they can expect. It can be between 1 and 1.2%, 1.2, 1.3%. What is the probability of very high volatility in one day? So what is the new parameter that gives me the sense of the fat tail distribution in the data, so forth and so on. So we can go through here. Okay, we have October, and the average, the point estimate of the volatility is between 1 and 1.2%, but we see that the new parameter is 6.3, and it's a bit higher than the July parameter, which is 6.1. So all these small details, they inform better what is the quantitative analysis or estimate of crude oil traders, and they can basically build their hedging strategies according to the volatility in the futures market or in the option market, so forth and so on. This is definitely not stuff for the ordinary person that needs to know if inflation is going to be higher or lower. But what we can understand is that the July contract, the new parameter is 6.1, and for example, this September 25 futures contract, the new parameter is 6.2, and the fat tail parameter for the October contract, future contract, is 6.3. So the futures market, what this the modeling tells me is that, okay, we have a futures market which is in backwardation. We have backwardation of the futures market. So we have futures prices which are higher now and lower in the future months, in the coming months. But at the same time, if I go deep into the data, then I understand that in futures contract there is a higher probability that we have a fat tail event, like in September or October, price discovery of crude oil prices. The modeling allows me to know before that the new parameter, this famous new parameter, this V, it's higher, and so we can have larger fat tail events. So basically we have lower fat tail events going forward, which means lower volatility going forward. So it's all very, very complicated, but I mean, it's a lot of work that I carried through. I'm still studying all these charts, because it's more than 200 pages of data. And for example, if we want to go through the gold modeling of daily returns, we can see here that the standard deviation for gold is 0.8% daily. The daily mean return are very close to zero, but they are slightly positive, very slightly positive. And the high density interval of daily volatility is between 0.7 and 0.9% for gold, and the new parameter is 5.1. 5.1, it's a small parameter, is smaller than 10, and So we can interpret the data, and we can assume that gold, the daily returns of gold, they showed in the past fat tail distribution, fat tail events, like gold going up more than 1% or 2%, or even gold prices going down a lot when you have very large negative days, -2, -3%. So you have large volatility. So that informs us that we can reasonably expect that gold daily returns, they exhibit fat tail daily returns at some point during their trading days. So that's basically whole contained for the modeling, the posterior mean distribution, probability distribution of the data. And yes, probably it would be useful to basically have a look at this, which are the high density interval for the daily, for the mean, which is the daily return. So all time series, they all display a high density interval which is close to 0. So daily returns, they are very close to 0. And yes, we have a table. Yes, I can show you here. I had to search it, probably the ARIMA model that I implemented for Brent price, and the forecast horizon. So it's the auto optimizing ARIMA model. The forecast horizon is for $80 per barrel for Brent crude price. So as I said at the beginning of the video, I said that I do expect prices to go higher towards the $80 mark, more or less. And yeah, we see December 2025 forecast 79.36, and it's a projected change of around 7% higher than the current price. When was, I think I rolled through the model this morning as well. And futures prices, WTI here, 74.5 for the December contract, and will go up by 2.2%. And here that's very interesting, because the ARIMA model it shows me that gold prices, they are going to go much higher, closer to the $4,000 per ounce. And by December 2025, the forecast is of 3,821.34 to the cent dollars. So it's $3,800, and gold price could go up as much as 10, 11, 12%, which is a lot. I mean, if you are in the business of speculation, having a 10, 12% upside, it's not small change. And as well as here, last but not least, copper prices. Copper, this is a copper, it's something that I will cover later. Somehow I have to prepare some very interesting material, but future prices are projected to be to go up again around the $4.95, $4.95, around the $5 mark, which is an historical all-time high. And I just want to add a little thing. You can all be aware or search that the actual copper reserves, the metal, the mining or the mineral reserves to have ore grade copper, they will be utilized completely in the next 30, 40 years, 50 years. There are estimated around 700 to a billion metric tons of copper to be extracted, between 700 million and a billion metric tons. The exact figure is a bit more than 800 million. And today we consume 22 million metric tons of copper per day, or per year probably, not per day. And so that makes the math like at 22 million metric tons of copper per year. It takes about 40 years to utilize all the ore grade copper reserves that we have in the in planet Earth crust. So this will mean basically that we will not be able to do anything anymore, because copper goes into everything. superconductors, EVs, you name it, everything. Copper, it's a material that cannot be replaced by anything else. But now, let's go back to our crude oil market study. And so the projection are, let's use this page here, of $3,850 gold price. Oh dear, sorry. Gold by December 25, and $80 Brent crude, and around the, let's call it 75, 77 WTI. These are all for, and copper prices will be around $5, but this will be exponentially higher going forward because there will be a structural scarcity of copper, and this will be very, very difficult for the global economy and for humanity indeed, because we will not be able any longer to produce any smartphone or any of amenities of any sorts. So what we can just go through quickly now is probably to have a look at the Garch models and to have an idea more or less of what are the structural volatility parameters for the main topic of the day, which is crude oil, and see how the model performed in its iteration. Alright, so what we have here is some Garch, these are all one more model, and so the generalized autoregressive conditional heteroscedasticity model. Okay, so we can appreciate that the p values, they are all very small, close to zero, so they are statistically significant, also the t value. And okay, so the baseline volatility is around 7%, 7.4%, and for what concerns Brent crude prices, the alpha parameter is 0.9, so past shocks, they basically the pass-through daily volatility by 9.2%, daily conditional volatility by 9.2%, and the beta parameter, so the persistency of volatility or conditional volatility across the time series is 89, like almost 90%. And so what the generalized heteroscedastic conditional volatility tells us is that we have past shocks, they tend to basically be persistent. Past shock or conditional volatility, they tend to be persistent across time, and there is some degree of persistency with conditional volatility. That's something that we have already seen in previous videos. You are invited to watch all my videos. They are very, very interesting. And for the GJR Garch model, which is not like any funny stuff, we have another parameter, which is the gamma parameter. So the gamma parameter, it helps us to understand what is the level of asymmetry in the shock of conditional volatility. So we have a 7.4% asymmetry level of shock in conditional volatility. So the asymmetry, of course, it helps us to understand how large can be the asymmetry of the conditional volatility in the time series when we have periods of high volatility. And it's probably easier to see a chart here. So it's Brent crude, annualized conditional volatility, and we have an overlay of the three models here. And we can see here we have a jump in the past period, which is it's significant of the fact that conditional volatility in oil market, it's going higher, and we can gather some data from visualizing the chart. We have a clustering here Okay, so we can expect that this build-up of conditional volatility going in a range between 20 and 40, what gives us the chart, it could theoretically, not theoretically, but on if we take the data of what are the past periods, we see that we have clustering of conditional volatility, and then we have a jump, and we have persistent higher volatility. We have periods of higher volatility. So we have a clustering here. We can expect probably there will be a higher volatility going forward. Of course, we don't have a crystal ball. We don't know, but we are aware that we are in a volatile geopolitical environment, and so the Garch models informs us in a quantitative manner with the data, with precise data. It informs us what are the level of conditional volatility, what is the level of asymmetry in the conditional volatility, and from the chart we can see if the line goes up or down. We can expect maybe higher volatility in the going forward in the following periods. And yes, so I could implement for the WTI, but the problem is the scale of the chart, because we have this huge thing which is referred to 2020. So let's have a look at gold. We see here that recent conditional volatility in gold market has been very, very high. And because we have, you see here like a chart, like let's take it as a technical analysis. We have a clustering and we have a build up, like a trend, a channel up of conditional volatility that's been building up since 2024. And then we recently have seen a huge move up of conditional volatility, which coincides with gold prices breaking all-time high records after all-time high records, and then we have some days when gold price drops a lot. So the inbuilt conditional volatility of gold market, it has gone up a lot, and we can expect that probably the conditional volatility of gold will be higher, especially if we consider the other if we put the data together and say, okay, I have an ARIMA model which is optimized, is 2-3 model, PQD 2-3 model, so it's 2 first difference, 2 autoregressive, 2 moving average, and 2 first difference of data. And I have this result and tells me, okay, listen, might probably go, it's projected to go at 3,800, and then I do some other modeling and I see that in the recent months conditional volatility of gold has gone higher. Then that builds up for me the information, the data points that I need to have, and have an idea more or less that probably gold prices could go higher, or there will be higher volatility, of course, which it's never in volatility is never in a scarcity. For as long as human beings, they are searching the price of stuff. Also copper price, we have higher conditional volatility in the past periods because copper prices, they are going towards all-time highs. And the copper market, the metal market, they are becoming aware that we have a lifespan of the global copper reserves from the mining standpoint, which can last 30, 40, 50 years at the most. After that, we will not be able to produce any smartphones unless we are recycling copper, but that's another kettle of fish. So we have higher conditional volatility in the past periods also for copper. So the commodity market is boring, but it's very interesting because it's real stuff. And we can't live without oxygen, we can't live without water, we can't live without bread, or the global industries, the smartphone, the electric vehicles, the even the trains, locomotives, or I don't know, solar panels, your wireless routers, anything, they cannot be produced without copper. Okay, copper is irreplaceable, and if we run out of copper within 40 years, I don't know what how we are going to define GDP according to consumption and production of things, because we will not be able to produce anything. Forget about smartphones. So gasoline prices, we have a build up here of conditional volatility. So maybe going forward, for example, in the summer season, we can have an increase in conditional volatility. Probably gasoline prices in dollar terms, they can go from $2 to $3 in the open market, and then it depends from petrol station to petrol station. Heating oil, conditional volatility is a bit subdued because we have a clustering of volatility here as well. So these are all very interesting data, at least if you just look at the chart and you don't go through the data, which is can be very boring. I understand it can be very, very boring, and I didn't basically just took only the commodities time series, oil and gold and gasoline and heating oil. I also managed to take the treasury yield curve data, and I can show you some more things which are pretty straightforward to see, which are very interesting. There is a wealth of modeling that I have, which is VAR models, VECM models, so I can see the impulse response functions or the error correction models when of the slope of the yield curve, what is the 5-year slope of the yield curve, what happens of the slope. If I have a negative slope, then according to what is the impulse from the oil price, I know what I can model through, and I know that, for example, I have a concave treasury yield curve. So these are all very interesting. So because the treasury yield curve is pricing a stagnating economic environment, so we have like a 4%, 4.5% front end of the yield curve. We have slightly lower yields in the belly, and then higher yields in the long duration of the 30 years, 10 or 30 years. We have 4.5, 4.9, 5% yield. So we have so the yield curve, the treasury yield curve, it's concave in this sense. Okay, so we have a negative slope between the 2, the 3, and the 5 years, and then it slopes up again. And I had fun in doing some VAR models and VCM models, which show me according to how these what is the impulse that the oil market gives to the yield curve, what happens to the according to how moves the oil market, what happens to the yield curve. Okay, so if I have a negative slope in the between the 2 and the 5 years, or if I have a flattening between the 2 and the 7 years, I want to show you this in very simple charts. I think you'll find it very interesting because it's very simple to see. So we have a very huge, you can see here how many time series it won't fit into the overall matrices of the thing. It's almost 40 time series. It's a huge amount of data. The machine had to do a lot of work, but you can see a lot of red. So there is a high correlation between all these, between oil prices, gasoline prices, heating oil prices, and there is a bit less correlation. Then you have here the level and the slope and the curvature of the yield curve. So it's a very interesting study. Okay, so we have this scatter plot, this scatter chart, all these dots scattering around, and it's basically the interpolation between the Brent crude volatility and the yield curve slope. Okay, so what it tells me, for example, if I have a negative here on this side of the chart, if I have a negative slope, a negative 10-year 1-month slope, I see that there is a lot of somewhat higher volatility here, but you have a lot of lower volatility here. It's it's very complicated because it didn't run a linear regression. I will show you some charts with linear regression. But what I can tell you, if we take this part of the chart, is that if I have a positive slope, we have more dots that are here for higher volatility. So the basic concept, which is I want to pass through, is that for a negative slope, we have somewhat of lower volatility, and the volatility here is expressed in 21 days annualized volatility. So a negative slope, it would mean an inverted yield curve. So that means that 1 month yield is higher than the 10-year treasury yield. So when the yield curve is pricing a negative slope, so an inverted yield curve, the interpolation of the Brent crude volatility of the data tells me, okay, you have a lot of clustering here. Okay, so we have somewhat of lower volatility, although it's 0.2, 0.25, or 0.3. When we move here on the positive side of the slope, so we have a positive sloping yield curve, so we have higher, longer rates compared to short-term rates, you have more clustering, perhaps in higher volatility. So that's the concept, that this kind of modeling of study or interpolation of data, which can be done in many ways, but I like to show you this thing. So let's see if we can find something more, a bit more of clarity. Okay, gold volatility. So the interpolation between the 21 days annualized vol of gold and the slope of the yield curve, the slope between the 10-year and the 1 month. When we are here in the negative slope, you can see that all of the dots, they are between 0.25 and 0.10. So an inverted yield curve, because it signals economic recession and theoretically lower inflation, then the 21 days of annualized vol of gold, it's contained within this range. When we move from 0 to the positive territory of, so we have a positive sloping yield curve, so higher rates, so we are discounting a positive economic growth, so positive inflation, you have dots here, you see, suddenly here they start to appear dots in a higher vol, in the range between 0.25 and 0.4. So I think this clarifies a lot the what's the most known concept of gold, which is an hedge to inflation. And we can see how how the market it's correlated. So according to how is the slope of the yield curve, you can expect higher or lower volatility in gold. So that means that people will tend to buy gold as a hedge of inflation if we have higher inflation and a higher economic growth. And so it's very fascinating if we have a recessionary period or a stagnation. So maybe you can expect lower stagnation. It's a bit different because you can have structural higher inflation, and that's you are in stagflation, and it's another kettle of fish. Same dynamic it's for copper here. We can see here that as we move along in the positive side of the positive sloping of the yield curve with the yield differential between the 10-year and 1 month, we have higher volatility. The dots, they start to appear for the higher volatility part of the copper price. And that's here the same, like taking the crude oil October future contract, we have the same level of interpolation, the same level of result. So if we have a negative inverted yield curve, negative slope, 10-year, 1 month, we have somewhat of contained lower annualized volatility. And then if we move along and we go to the positive slope, then we have higher annualized volatility even in futures contract. So this is very, very I like it a lot because it's very informative, it's very easy to understand, and also the charts, they are very nice. You have all these dots they are very funny to see. And I want to show you something more precise with the linear regression, and I think I can show you some other stuff. Okay. That's very interesting. So here we can see, with this chart, we can see the evolution of the yield curve. Okay. Let me make it larger for you all. I hope you are enjoying the video. Leave a like, drop a comment, I don't know. Do whatever you want. I hope you are enjoying. This is very, very interesting. So here you have a table which basically separates in in years the evolution of the yield curve. So this one is 2020. So you can see here this pink line is the most recent level of the yield curve, and we can see that we are at levels which are above the term structure, the yield curve term structure of 2005. So we are at yield curve term structure level which are very similar to 2005, 2007, 2008, 2009. So we are near 20 years ago. But this is by far the highest level, the highest term structure of the treasury market. And that's something very important to consider. And we have another thing that we can take with us, is that the red line is the yield curve, the treasury market term structure in 2005, and the starting point is 2%. So that means that Fed funds were around 2.5%. Today, Fed funds, they are 4.33%, and I think in the coming days there will be the Fed meeting. So we're starting from a higher, much higher money market rate, dollar money market rate, and with the risk of having long treasury yields going to 5 or 6%. So that's another volatility risk in the treasury market, which we can easily link and build with the volatility risk of higher energy prices, because the moment oil starts to go up, we have higher inflation, and then the treasury markets starts to moving accordingly to higher inflation. They will start to discount higher yield, higher coupon rate, and so the whole thing starts to move, the whole term structure starts to move higher. And that will be very, very fascinating. And as I was saying, we have here the linear regression chart. So we have basically an interpolation, not just only with the 2-year yield, and the chart, it's easy to understand. So we have for example, we have the January 26 future contract, crude oil future contract, which runs a linear regression with the 2-year yield. So we have the 21 days annualized volatility of the future contract running through a linear regression with the 2-year yield. And we have a negative slope, so we have a negative correlation. And the next chart basically compares the yield with the volatility. And we can see here that the volatility of futures contract, of course, is much higher than the volatility of the 2-year yield. Okay, so we have some sort of divergence, which is very reasonable to presume. Okay, and most of the these charts, basically they have a negative slope. And yeah, we have here, you see the yellow line is the yield, the 2-year yield, and the red line is heating oil annualized volatility. So you can see here what is the comparison of the two. And yeah, crude oil, let's see if we have some near contract, November, December. Okay, this is a bit of a mess. It's another modeling that I tried to run through to see what was the linear regression between basically oil prices and the 2-year yield treasury or the 7-year yield treasury, just to have a rough idea what is the behavior of energy prices and the treasury yield curve, whether it's the 2-year or the 7-year, like short term, not short term, but the belly of the curve, what is the behavior of the volatility and energy, crude oil prices or gasoline prices, this sort of thing. So I think I can show you some other stuff, which is this one. Okay, that's always starting from the evolution of the term structure. We can see here the time varying sensitivity analysis. So we have a rolling correlation between see R square. We have the rolling correlation between 1 year rolling correlation between Brent crude and the 10 year and the 30 year. So I divided, because there is a lot of data, I went through what I basically analyzed the slope, the interpolation between oil prices, gasoline prices, and the slope of the curve, or gold prices, metal prices, slope of the curve. And then I tried to gather some more data by doing an interpolation with the 2 year and the 7 year. And then I said, okay, I need to know now what happens in the long duration of the curve, which is the 10 year and the 30 year. And we can see here, for example, that from 2024 going into 2025, we have the correlation between the Brent price and the 10 year or the 30 year has increased a little bit. So the adjust R square is 0.35. It's not a very large parameter, because a statistically significant correlation, it's a parameter larger than 0.5. But nevertheless, we can see here that higher volatility, when basically with the oil prices going up again, we have a rolling correlation with treasury, long dated treasury, which starts to go higher. And then we can see here in the past months it's normalized, and then we have a curve. And I presume that if whenever I will keep running these models, I will see higher volatility. Also here the same behavior with gold, rolling adjust R square between gold and the 10 or the 30 year yield treasury. We have an adjust higher correlation between the move up in the yield and the move up in the price of gold, or the move up in the price of, as copper prices go up, so the yield of the 10 year, the 30 year has gone up, because we are discounting higher inflation going forward. Whether it's WTI or Brent prices, or it's metal prices, then there is all the data that the machine gives me are the top 10 most correlated adjust R square coefficients, and these are the basically the futures contract, which is where is heating oil or crude oil, and then it run through the first difference just to have another level of data. So the concept that we can basically gather here is that there is a rolling correlation between higher oil prices or higher copper prices and higher yields in for the 10 year or 30 year treasury bonds. And that's also very important for basically higher inflation will give us higher cost of borrowing and higher so that would be difficult for economic growth. So I think that's all for me for today. I will spare you the the VAR models and other things. I hope you enjoyed this video, and please subscribe, thumbs up, and yeah, thanks a lot. Be peaceful, and see you to the next video. Thank you.